Good afternoon, everyone. This is Mary Nella Collado. Most of you know me as Nella, and I am here with Yesenia Ramirez.
Good afternoon, everyone.
Welcome to our 2018 year-end tax planning. We are going to give it about a couple more minutes so that we give people some time to log in, and we'll be starting shortly. Stay tuned. Okay, so let's get started. Yesenia and I, we love the topic of tax, so we are excited to go over some of the key tips to consider before the year comes to a close, especially in light of the recent changes to the tax code. That always makes it interesting. Before we get started, just a couple of housekeeping. These are some general tax planning ideas. They may or may not apply to you. So, before you implement any of the strategies that we're going to talk to you about during this presentation, it is always advisable that you speak with your CPA or your financial planner. Give us a call. We can, talk to you with specific situations for you. So just general housekeeping and disclosures.
Additionally, if you do have any questions throughout the webinar, please feel free to add them to the question box. It should be on the bottom part of the GoToMeeting screen. You can just click on an arrow and add in any questions, and we're going to answer them at the end of the webinar.
Great. So you guys know me. I am the CEO and Senior Financial Planner here with Tobias Financial Advisor. I work very closely with Yesenia. And
Absolutely. And I'm Yesenia Ramirez. I've been here since March of 2017. I'm an associate advisor here with Tobias, and very excited to talk to you all about taxes today.
Okay, so Yesenia, I think some basics on year-end tax planning. Why is year-end tax planning so important? What is it?
Well, year-end tax planning is really important for a lot of reasons. Many people, whenever they think about taxes, I know that they have that April 15th deadline in mind. And usually by then, it's really too late to do any of these strategies. So we like to call it year-end tax planning because that's exactly what it is. We're looking at our taxes at the end of the year. And the reason we do that is because there's a lot of deadlines on 12/31, December 31st. So it's really important to start looking at your taxes before the end of the year to see if any of these strategies are applicable to you and see if you could take advantage of any of them.
And I think the nice thing is the way we approach tax planning is this proactive approach. It's really looking at where somebody is on November 13th, actually running the numbers and seeing what their tax picture looks like today, and then really being able to step back and see what opportunities they have. Because the overall goal with year-end tax planning is that you're trying to maximize tax savings, not just this year, but over multiple years. And sometimes depending on the different opportunities that we're trying to plan for, we're really looking at multiple years.
Absolutely. And then another big thing is just to avoid any big surprises. Once April 15th comes along and you have a big tax bill, there's not much you can do other than pay it or even go on a payment plan with the IRS. And we've seen this where we've had a client come to us after they file their taxes, they're on a payment plan, and they're making estimated tax payments for the following year. So this really helps avoid that headache and just overwhelming situation of having to owe a big tax bill in April 15th.
So, I know I sure know a lot of friends and family members who are kind of do-it-yourselfers, but why is it so complicated? Why is tax planning so complicated? Let's talk a little bit about what makes it so complicated.
Absolutely. So I would say this year is probably one of the best years to explain why it gets complicated. Tax rules change. They could change from year to year, and actually this past year for 2018, we've had the largest tax overhaul since 1986. So this is one of those fluid years where everyone's still trying to figure out where everything's gonna fall at the end of the year. So that's one of the reasons it gets complicated. What used to apply may not apply anymore. So trying to figure out where you fall in those new rules is one of the reasons it gets a little complicated.
Exactly. Tax brackets are different. Whatever deductions are allowable are different. The limitations are different. And believe it or not, there are some new opportunities also open up for our higher earning clients. We used to be subjected to the overall itemized deduction phase out. So that's now gone. So essentially, when you have someone with significant levels of income who are also very charitably inclined, this is a good year because opportunities open up. So, talking about complexity, uh, we have so many different strategies to juggle, so many different applicable tax rates. You can go from 0 to 15. I mean, you're looking at so many different moving parts.
All right, so Nella, we know what tax planning is, why it's a little complicated. So what's the overall goal? What would you say is the most important thing we're trying to do when we're looking at year-end tax planning?
So, and again, it goes back to, I'm going to say, crunching the numbers and really getting a good handle on what is the ideal timing to recognize income, because some of the items of income that we generally have to recognize, we could have some control over them. If we think about folks with IRAs, maybe folks who own their own businesses, it's trying to find that ideal timing to either accelerate or defer the recognition of different types of income items, but also deductions. What is the benefit of accelerating some charitable gifts versus deferring them, and how really to maximize the rate that you're paying on income, and also maximize the deduction that you're getting on whatever is applicable to different clients.
And even for those that are just W-2 employees, let's say you don't have a lot of control over your income, being able to manage those deductions, you do have a lot of control. So whether you're a business owner or an employee, you do have some control over where you fall in year-end tax planning.
So I guess the overall thing to keep in mind is that year-end planning has to be done before year-end, because we cannot, unfortunately, we don't own a time machine. We're not going to be able to go back and implement some of the things that would have saved on the overall tax bill. So what we thought we'd do a little bit different this year is we're going to just cover 10 tips, the top 10 tax saving strategy tips, and we're also going to just add a little bit of color on how some of them are different this year because of the changes in the tax laws. So let's talk about tip number 1, and I think most of our clients, they hear us say this at every meeting, every call, pretty much this idea of maximizing your contributions to your 401ks, okay? And this is essential because a contribution to a 401k must be done in the year that it's for, okay? So by December 31st, the goal for us, for our clients, is to be able to reach the maximum of either $18,500 if they're under the age of 50, or with the catch-up $24,500. So Yesenia, let's talk a little bit about why we're so passionate about making sure that our clients maximize their contributions to their 401k.
Absolutely. So with the 401k, it does a few things. So typically, the dollars that you put into your 401k are pre-tax if it's a traditional 401k. So not only are you saving money for retirement, but you're also getting a deduction. Essentially, you're lowering your taxable income. And the reason you do this is because you anticipate you'll be in a lower bracket in retirement. So you're avoiding taxes this year, maybe when it's a little bit, your taxes are higher, and then in retirement, when you do take out those funds, you're ideally in a lower tax bracket.
But let's talk about that too, absolutely, because the bracket is an important factor to consider. Mm-hmm. You should maximize. So we all agree that maximizing contributions to your 401k is an important tax saving strategy. Now, whether you maximize into your traditional or Roth 401k is a whole different discussion. And we talked about the what is your current tax bracket versus your expected future tax bracket. So that is a conversation that is super important. We had this restaurant owner. So he owned a restaurant. His wife was a teacher, and so he was running losses through the restaurant. And the teacher had wages, so she collected, employment wages. But no one ever had that discussion with them about what bracket they were in, and she was making contributions to a traditional 401k, and it was yielding zero tax benefit because they were already in the lowest tax bracket anyway, because he had business losses that were offsetting her wages. So in that case, it would be a really, bad planning strategy to go into a traditional 401k because there's no tax benefit today, and then it's going to be taxable in the future. So knowing what bracket you're in today versus where you expect to be in the future is a key factor to determining where your 401k contribution should go.
Absolutely. And then another thing with the 401k is you want to take advantage of any company match. So this isn't even tax savings. This is just whether or not you're going to leave free money on the table. If you're contributing to a 401k, it's very likely that you're receiving a company match. So even if you're not maxing out the 18,500 or the 24,500, you want to make sure that you're contributing at least up to the company match, that you're not leaving money on the table.
And most of the matches that we've seen, it's typically it'll be 100% of the first 3% you contribute, and then 50% of the next 2. So in effect, for the typical plan that we've seen, you have to contribute at least 5% of your wages so that you're getting the full company match. And then, in line with the 401k contributions, we also push the idea of maximizing contributions to IRAs. So one key misconception that we're hoping as mythbusters, right, like that show, here's a big myth. People think that some people think they can't contribute to an IRA. How many calls do we get, Yesenia, on, I can't make a contribution to an IRA? Let's talk about that, because I get calls from CPAs, clients, friends, family. I mean, these are the questions we get.
Absolutely. So the biggest misconception is surrounding the deduction, essentially. So people say you can't contribute to an IRA because you're not going to get a deduction. We said, no, that's not true. Anybody who is under 70 and a half and has any earned income can contribute to a traditional IRA. Doesn't mean it's going to be deductible. That's the big misconception. So whether or not you get a deduction is going to depend on your income. But whether or not you get a deduction, you still want to put funds into that IRA because you are getting tax-deferred growth.
Exactly. And if you think about, especially if you're in your 20s and you have the cash flow that enables you to just add funds to an IRA, even if your income is above the allowable threshold to go to a Roth, which we'll talk about in a little bit, it's still a smart tax strategy to make that annual contribution to an IRA. And who knows? Now you have some basis, right, because you weren't able to deduct it. And then in the future, you might have an opportunity to do a Roth conversion. So we're going to talk about that as well. So that was one big myth that we wanted to make sure we discuss, and also to remind folks who are 50 years old or older that they also have that catch-up contribution that they can do to IRAs.
And also, I want to go back to the 401k, something that we missed. Be very careful. If you are eligible for the catch-up, you may have to specify that you want to contribute for the catch-up. Some employers treat it as two different things. So you may think you're maximizing, but if you're over age 50 and you want to contribute that extra $6,000, be sure that you've spoken to your HR department and that you're going to get the full max.
And one more point before we move away from the 401k is a lot of companies allow for what's called an after-tax contribution. So this is above and beyond your deferral maximum of $18,500. The total cap that can go into a 401k is actually around $55,000. We can only defer $18,500 or $24,500. But if the employer plan allows you to make additional after-tax contributions, you may want to look into taking advantage of that, because even though you're not getting a deduction, it goes back to what we were talking about. Now you have a nice pool of funds after-tax contributions that you can eventually do a Roth conversion with, and you can do it within your plan. A lot of times, we have a client I think that's doing that.
Absolutely. We have a client who is able to put in after-tax contributions to the 401k, and then some employers require you to manually request the Roth conversion, but this plan actually does quarterly Roth conversions of those after-tax dollars, so he's really taking advantage of all the benefits that are allowable.
And speaking of Roth, Roth conversions, I think is a planner's best friend, especially when you have an opportunity to do Roth conversions and pay very little tax. One thing that they recently changed in the tax law is that you cannot recharacterize them. In the past, you were able to convert your traditional IRA into a Roth, and then you were able to wait until October, the extended due date of your tax return, so October of the following year, to see if it was a good deal or not. So when, if the market went down, you were able to recharacterize that back, so undo your Roth conversion. They did away with that. So now when you're thinking about Roth conversions, you have to make sure you really crunch the numbers, and it's something you want to do because you won't be able to go back and undo it. But let's talk a little bit about who should be considering Roth conversions. So the big planning opportunity is if you have an extraordinary year for one reason or another, an extraordinary in a negative way, let's say, because maybe your spouse owns a business, back to the example, and maybe they're running losses this year that is not common, and it won't repeat in the future. So pairing that loss with a Roth conversion is, a tax planner's dream, because essentially you're converting a tax-deferred account to a tax-free account without paying Uncle Sam $1. At least that's the strategy.
And then other people can also consider some Roth conversions. Let's say you don't have a traditional IRA to do this, you may want to consider doing it within your 401k. So this is something that you'll have to ask your employer about, see if it's allowed by the plan. But some of them do allow in-plan Roth conversions of any funds that are 100% vested. It could be a 401k, 403b, or a 457b plan. And that's another type of conversion that once you do it, you can't go back. So that's something you want to make sure you want to do that Roth conversion before you do it. But it is an excellent strategy of turning pre-tax dollars into Roth funds.
And the other thing we do for some of our retirees is we play, I say play because I actually enjoy this, so we play the tax bracket game. So essentially, for those folks who have large IRA balances and they're worried about their children eventually having to pay tax on it, so we can take advantage of the tax bracket and really do small rounds of Roth conversion so that we're converting tax-deferred dollars to tax-free, and we're doing it in a smart way to try to take advantage of the lower brackets. We don't want to do it so that you're paying the highest bracket, but we want to be able to take advantage of possibly lower brackets, so do smaller Roth conversions every year. And the other thing that is essential for Roth conversion planning is this idea of rolling up any existing IRA balances, so that when you do a Roth conversion of future IRA contributions, you're basically converting all non-deductible IRA contributions. And that gets a little bit complicated, so if that confused you a little bit and you want to talk a little bit more about how that works, we can have a one-on-one discussion with you.
Absolutely, but the big thing to know with Roth conversions is that there are no income limits. Unlike a Roth contribution, if you have too much earnings, essentially you can't contribute to a Roth, but there are ways outside of those income limits of getting funds into the Roth.
So, charitable giving. So, this is a big planning opportunity given the change in the tax code, and we're going to talk about why that is. So one of the major changes affects your itemized deductions and your standard deduction. So one of the big discussions during the proposals was this notion that everyone was going to be able to file their tax return on a postcard. So if we have a postcard the size of a city block, maybe we can accomplish that. So, the way that this was proposed is that if we raise the standard deduction, less people would have to itemize, so it would be quicker to pretty much calculate the return. So they increased the standard deduction from $6,300 for folks that file as single to 12,000, and for married folks, they increased it from 12,700 to 24,000. So what that means for folks that are charitable, who maybe live in a state with income taxes or pay significant property taxes, is that they may not be getting over that higher standard deduction hurdle. So planning becomes even more essential because, especially for charitable gifts, if you don't plan accordingly, you could be, you won't get a tax benefit essentially for those donations. So we come up with creative solutions. So we have a solution for folks that maybe, they're giving, let's say, $1,000 a year, but it won't get them over that standard deduction hurdle. So we create a little parking spot for your charitable contributions, which is called a donor advised fund. So the idea is that we would take your charitable contributions for the next 6 years and we bunch them, let's use bunch them, and we basically put them in a donor advised fund so that you're able to get over that standard deduction hurdle. You're able to deduct everything in year one, and then you can, at your leisure, make a request to transfer funds to whatever charity of your choice you wish to do that donation to over the next 5, 10. There's no time limit essentially, and that's the perk, right, Yesenia? Is that
that's a huge perk because not everybody knows. For the next 6 years, who knows what charities are going to touch your heart in the next few years? Which ones are important to you and your family? So you have time to think about which ones are important to you. And this is actually, aside from the tax savings, it has another added benefit of maybe even getting your kids involved if you want to start talking about charity. Now you have this fund specifically allocated for charity. You could get them involved and have a conversation around the table and see what's important to you and where you'd like to donate that year.
I love the family aspect of it, especially with Thanksgiving around the corner. I tell my clients, this gives you the opportunity to start getting your children involved in discussions that are important to you. If you think about creating an environment where your kids will be good stewards of your money, this is a good starting point. I know we had a family that said, how can I start these conversations? And we said, well, why don't we start with a donor advised fund? And this way, we pump all the funds in there, we lock in that tax deduction in the current year, and then we start discussing with the children what donations are near and dear and important to us. But so in this scenario, you see that what they did is they front loaded $6,000 of contributions so that they went above the standard deduction. So in this case here with the bars here, this person, assuming they were in a 25% tax bracket, a $6,000 contribution saves them $1,500, or said differently, it cost them only $4,500. And this is assuming they made the contribution in cash. So which takes us to our tip number 4, appreciated securities. So, with the changes in the standard deduction, a lot of the charities, I know that we work with a lot of local charities here, and one of the biggest concerns they have is we're going to lose all of our small donors, Nella. What do we do about that? What are some of the tax incentives that they can consider, because maybe they won't be able to get a benefit for that donation? So I said, even if somebody is not able to itemize because they're not going over the standard deduction, there is a way for them to make that donation and still get a benefit for it, which is another one of Yesenia and I's favorite planning strategy, which is donating appreciated security.
Absolutely. So the big benefit with donating appreciated security is, let's say you have a stock, let's say it's Apple, and it just doubled in the time that you've had it for over a year. And in order to actually to donate, you would have to sell it and give them cash. You would have to pay capital gains on all of that appreciation. Now with this strategy, instead, you could just donate the actual stock, and what happens is you get to ideally deduct the full value of the donation. But even if you can't, let's say you can't deduct the fair market value of the stock, you still get to avoid paying capital gains on all of that appreciation. So you still get a benefit whether or not you're itemizing.
Exactly. And then I like to look at it differently, even if you say, well, I don't have to sell my Apple stock, Yesenia, I don't have to sell my Apple stock to make this donation. I have cash available. We would still want you to donate the Apple stock, because then what you can do, and in this example, let's say it's a $50,000 donation. So you have $50,000 available to make your donation. That's all well and good, but you also own Apple. So we're going to recommend that you donate the Apple, equal to 50,000. And then what we can do the very same day or the very next day is we're going to replace those Apple shares with the cash that you were going to use for that donation. So what you've essentially done is you've given yourself a free step up in basis in those Apple shares, because you want to keep holding them. So this is an opportunity that people often miss. And I actually had one client say to me, well, no, I don't want to do anything illegal. This is totally within the law. It's definitely a strategy that works. You just have to make sure that you implement it correctly, because if you don't, then it could be a failed strategy. So speaking of capital gain, perfect segue, Yesenia. Tip number 5. So what are some of the things that we are actively doing within all our client portfolios?
So now that we've had a bit of a rocky year, we're actually going to use that to our advantage and make lemonade out of lemons. So we're going to look at your portfolio and check to see if maybe there's any losses that we could harvest to offset them against any gains in the portfolio, or vice versa. Maybe somebody is in a very low tax bracket and we could take advantage of accelerating gains so that they essentially pay 0% on the appreciation in their portfolio.
Exactly. And another missed opportunity, well, this year-end tax planning is personal year-end tax planning. Most of our clients are beneficiaries of trust. So it becomes really important to look at the capital gains within those irrevocable trusts, because as we all know, irrevocable trusts do not pass out the capital gains to the beneficiaries. So you want to make sure that within the trust, you're also looking at what are the realized gains and losses year to date, and if you have any losses available to offset those gains, that you do that within the trust as well. So this is essentially you're turning a paper loss into a tax loss, just to be able to offset that income. But we do want a couple of warnings here that I know we have to actively be careful with, is we do have to be careful with the wash sale rules. So the IRS knows that these smart tax planners are thinking about this. So one of the things they don't want us to do is trigger a loss for a security that we absolutely love and we want to keep holding. So they don't want us to sell the position, take the loss for tax purposes, and then the very next day go ahead and repurchase it. If we do that, they're going to basically disallow the loss. So we have to be careful within our portfolios, and this is something that kind of marrying the tax planning with the portfolio and investment management. We also don't want to let the tax tail wag the dog, so we have to make sure from an economic standpoint it's a good move. So if we take a position, let's say maybe some of our emerging markets, and we trigger some of those losses, we also don't want to be outside of that asset class for too long, because then economically we could be worse off. So what we try to do is when we trigger those losses, we replace that particular holding in that asset class with a security that's not substantially similar, so that we don't trigger the wash sale rules. Again, kind of marrying the tax planning with the investment management. But there's a lot to talk about on loss harvesting. Again, maybe helping to avoid that 3.8% Medicare surtax. Some people know it as the net investment income tax. Again, so you're kind of managing a lot of moving parts, but loss harvesting and gain harvesting is a key thing to do at year end.
Absolutely. And another important thing to look at in the portfolio is to look at any worthless investments. This might be a good opportunity to get rid of an investment that's just kind of been dragging there. It's gone under, it's not doing anything. So maybe we can sell it to the custodian, or even I think we've had a situation where we had to go to the actual CEO of this company and have them buy back the stock for $1 so that they could take advantage of the loss.
And that's the best, actually, that's the best approach for to take a loss on worthless securities, because if you just claim it as worthless, it has to really be worthless. But if you sell it for $1, that's not a questionable transaction. The IRS can come in and say, well, prove to me it was worthless. Well, here you sold it for $1, so that's going to enable you to take the loss. But we have jumped through a lot of hoops to do that for our clients.
All right, now tip number 6. This has to be one of my favorite tax planning strategies, and it's the health savings account. And one of the reasons we love these accounts is because I find them even better than a Roth. So we love Roths because it has tax-free growth. But what's amazing about health savings account is that it's truly the triple crown of deferred savings. So when you put funds into this account, it goes in tax-free. You can invest it just like a retirement account, so it's going to grow tax-deferred. And then in the future, when you have qualified medical expenses, you can actually take out the funds tax-free. And this is the only account where you could truly evade taxes, as long as it's used for the right purpose, of course. So the big caveat to this kind of account is, unfortunately, not everybody can open it. It really depends on what type of health insurance you have. So you can only have a health savings account if you're enrolled in a high deductible health plan.
And it has to be HSA eligible.
Correct. So all because you look at the minimum annual deductible, it's $1,300 for a single plan, $2,700 for a family plan. Even if yours are higher than that, you still we do recommend you call the health insurance and ask if it's an HSA eligible plan, just to make sure. And this is going to offer you an above the line tax deduction. And a really big thing to note with HSAs is you don't have to have your employer actually have an HSA open for you. It's a big misconception. People say, oh, I have the high deductible plan, but I can't put in the dollars pre-tax because they don't have one. So what you can actually do is you could even Google it and just look for HSAs, health savings accounts at any bank. There's quite a few of them, and open it on your own. And then when you go to do your taxes, you just tell your accountant that you've made contributions, and then you're just going to put it on your tax return, and you're going to get the deduction that way.
Exactly. So a couple of little things to note with these also is that they're, in addition to just making the regular contribution, you have a catch-up for taxpayers who are 55 and older. So not 50 like the 401k and IRA. So if you're 55 years old and older, you and your spouse, assuming you're both over 55, you can both do the catch-up, but it would require spouse to also open up a separate one. But I think what's the neat planning opportunity here is for our high income earning clients is we actually recommend that, they pump in as much as they can to their HSA and not use it. We kind of incorporate the HSA in their overall investment plan, but we tell them to definitely keep accumulating receipts for medical expenses, because we can accumulate 5 years, 10 years, 20 years of medical expenses and then take a tax-free distribution.
Absolutely, and this is not a use it or lose it account. You do not have to use the funds you put in there by the end of the year, which is how you can accumulate all those receipts. You can just let it grow over the years, and then after you've had all your receipts, you want to take a distribution, you can do so later on in the future.
And I'm sure there's an app for that, right, Yesenia?
There absolutely is an app for that.
So tip number 7, and this is one of, I think, probably one of the most frustrating aspects of tax planning or tax compliance. As Yesenia was saying, nobody likes a surprise, especially, well, I like surprises, but not from Uncle Sam, not from the IRS. So nobody likes a surprise, especially when it comes to owing. So if you're able to do proactive year-end tax planning, you're managing your expectations, you're looking at the numbers, you're looking for opportunities, and then you know more or less what you will be expected to owe or what is the deficit. And then more importantly, once you know what that deficit is, what are some of the things that we can do before December 31st to try to make up that difference so that you're not paying the IRS a penalty for underpaying your estimated tax payments, because that really hurts. I mean, Nobody likes to pay a penalty. So what are some of the things that we do? We when we see folks with IRAs and required minimum distributions offer a huge planning opportunity. If you have an IRA, you should never be in a position where you're paying underpayment penalties, because if someone is doing proactive tax planning, you have time before the end of the year to take that required minimum distribution and withhold as much as you need for the entire year. Because the beauty, Yesenia, right, of withholding.
Tell me about the beauty now.
The beauty of withholding is that, unlike an estimated tax payment, the IRS treats withholding as if it was paid pro rata throughout the year, even if it's done on December 31st. So that's why for some of our clients, we tell them, if you have a significant required minimum distribution, don't make estimated tax payments. Don't worry about that. Why should you be pulling funds out of the portfolio? Keep it invested or keep it in your high yield savings account. And then come December, run the projection, see how much you owe, and then fulfill most of that withholding or all of it through your required minimum distribution.
And then another thing to note is you don't even need to be 70 and a half. If you have an inherited IRA, this strategy works as well.
Beautiful, beautiful point. And the other thing for a lot of our business owners, if you own your own business, so you own an S corporation, whatever type of business, and at year end you're drawing a salary because you want to make sure you're doing other types of planning, you can also take a bonus and withhold from that bonus all of the withholding you needed for the entire year. So again, there's some just basic tips. And for our regular employees, right? So how many pay periods do we have left for the balance of the year? It's November 13th.
At least 3.
Right, at least 3. If you're paid weekly, you have at least 6. So even if you ran the numbers, you're a little bit short, you could be subject to a penalty, then go ahead and increase your withholding to make up for that difference in the next few pay periods.
And that's also something important to look at the beginning of the year as well. It's better to pay that tax throughout the year than the last few pay periods, but it's kind of like a last resort. If you do what you got to do for the last few pay periods, but if you do have to adjust, we recommend looking at it at the beginning of the year too, so that way you don't have to do a rush at the end.
Tip number 7. So speaking of IRAs, so my folks out there with IRAs, those that have to take required minimum distribution, the tax code made permanent the strategy of using your IRA distributions to fulfill your charitable philanthropic goals. Essentially, we can transfer funds from an IRA directly to a charity of your choice, and that is called a qualified charitable distribution. And as long as we do that, what we're doing is we're taking an above-the-line tax deduction. Everyone loves above-the-line tax deduction. That's basically a dollar-for-dollar offset. You're reducing your taxable IRA distribution by the amount that you transferred to a charity of your choice. So here, Yesenia, it doesn't even matter if the person's itemizing, right?
Exactly. So if you donate directly from your IRA, whether you're itemizing or not, you're going to get 100% of the benefit of every dollar that you're donating to the charity, which is amazing. And then we've seen it have a few other effects in regards to into your taxes. One is that it's going to affect your AGI. It's going to lower it, in fact. And there's a lot of different things in the tax return that depends on that AGI. One of them is those medical deductions. It depends on AGI. So if you had taken that RMD, you would have had a high AGI. Maybe you wouldn't have been able to itemize. But now that you've lowered your AGI by donating to the qualified charitable distribution, maybe you'll have a double whammy and be able to itemize this year as well.
And one that really frustrates a lot of our retirees, those that are currently on Social Security and on Medicare, where they're paying a Medicare premium and they see their Social Security check being reduced by the Medicare premium. This is a really good strategy to control your total income, because the higher your total income, the more that you're going to pay in Medicare premiums. So a lot of our clients, they say to me, Nella, how much of a qualified charitable distribution do I need to do to keep my income below that threshold where I pay the least amount possible for my Medicare premiums. And then we play with the numbers. We literally play with the numbers now. We run different scenarios to show them, hey, if we do a $10,000 QCD, you get right below 170,000, and you're going to pay the least amount possible for those Medicare premiums. So this is an amazing strategy for folks that are over 70 and a half, do make donations, and may not see a benefit because of the higher standard deduction, or are seeing their Social Security checks being reduced by higher Medicare premiums. Tip number 9 for our business owners, and not necessarily business owners, folks who may be employed, have a full-time job, but may have some consulting. Yesenia here tutors our mathematician here. So if you have your you do something on the side, it could be consulting, you're on boards of different corporations. I used to have folks that, because they were on boards, they would get substantial consulting income. And so a solo 401k enables us to make an additional contribution to a retirement plan. And depending on your specifics, we can even put this type of plan, I call it putting it on steroids. We can essentially overlay this with some type of defined benefit plan, but these are things that you must absolutely have in place by December 31st. The SEP IRA works a little bit different. You can set that up before the due date of your tax return, but that may not allow you the largest deferral and profit sharing contribution. Anything to add on here?
Yes, and just a big difference between the SEP IRA and that solo 401k. The SEP IRA is a good option if you've missed the 12/31 deadline. It does allow you to do the profit sharing contribution, but what's really nice about that solo 401k is that you're allowed to contribute as an employee, so you're subject to those $18,500 or $24,500 if you're over 50, plus the employer contributions as well. So it really does allow you to put more into the plan than the SEP. But they're both good options depending on your level of income.
And a big misconception, just to piggyback on that, is I have some clients say, but I'm living on the cash flow from this consulting income. I'm living on those receipts, and if I take it and I contribute it to a solo 401k, then there goes my cash flow. Well, most of our clients have significant portfolio accounts. So the contribution to your solo 401k does not necessarily have to come from those streams of income. We could fund it from any other account. Essentially, the whole point is to just get it funded. It doesn't have to necessarily be contributions from that particular source of cash.
Exactly. So you're just moving from one pocket to another, reducing your taxable income, reducing your taxes, and changing it from taxable funds to tax deferred.
Beautiful. And our last tip, this is something that we focus on because we usually work with clients who might be at or near the taxable estate tax exemption. So they did increase it. As part of the tax reform, the federal estate tax exemption went from $5 million all the way to $11 million $2. And one thing that we didn't mention is that all of these changes in the personal income tax code, they are subject to sunset. So all of this is in place through 2025, and if they don't make it permanent between now and then, all of this is supposed to revert back to what it was before. So we could very well be in a situation where someone went from a $5 million exemption to an $11 million back to a $5 million. But either way, we do want to make sure that we talk about annual exclusion gifts. This idea of making annual exclusion gifts to your children and your grandchildren is something that you should absolutely be considering if you're near or hovering around the estate tax exemption levels, because you want to be able to reduce your taxable estate. And there are many ways, Yesenia, that we normally advise our clients to make these types of gifts. We have different vehicles. You want to talk a little bit about that?
Absolutely. So whenever we say these gifts, many folks think we're talking about just a direct cash gift to their bank account, but it doesn't necessarily need to be that way. One of our popular ideas is to fund them through a 529 plan, especially for grandchildren. And what's nice about the 529 plans is that you're not only limited to the 1 year of annual exclusions, you're actually allowed to front load it for 5 years. So that means a single person can put $75,000 into a 529 plan for their child or grandchild, or 150,000 if you're married, for the next 5 years. So it really gets that benefit of tax deferred growth. And then another option is to maybe fund your child's IRA. Just have it as an incentive, maybe or a Roth IRA. We'll match if you'll match. It's just a really good way to pass on some of these funds, get them out of your estate, but maybe for a specific purpose.
Exactly. And the other thing too, going back to the financial training wheels, if you have children and grandchildren and you want to start having these discussions, sort of giving them an opportunity to have a vested interest in something. This is a nice way to make these annual exclusion gifts and be able to have these discussions, but also shifting income. So if you're making annual exclusion gifts to your children or grandchildren, they may be in lower tax brackets. So it's also an opportunity to potentially have some of the income from these funds be taxed at lower rates. And one thing I'll mention here is for folks who have an insurance trust, they do have to be careful because the way typically life insurance trusts work is that the annual premiums, the gifts made to those insurance trusts count as annual exclusion gifts, so you want to make sure that you don't go over. But if you do, it's not the end of the world, so we just have to file a gift tax return and just show the IRS that we've dipped a little bit into the now $11 million estate tax exemption.
And then another great way to give gifts in a way that they don't actually count as gifts in the annual exclusion is to pay for medical and education expenses directly to the provider or to the school. And this is not limited by 15,000. So that means if you have a grandchild, let's say they're 18 years old, you haven't had a chance to fund these 529 accounts, you can actually pay for the tuition for school directly to the school, and it's not going to count against your annual exclusion for that year.
Exactly. You have an unlimited exemption for medical and education, but the key thing is paying it directly to the provider or the institution so that it doesn't count as a gift.
Exactly. You can't give it to your child or grandchild and then have them given the check. It has to go directly to the provider.
So that concludes our presentation, our top 10 tax tips. We're going to open it up for some questions. We see a couple of questions coming through here. Okay, we have a long one here. We're going to just stretch out that little pane so we can read it, or not. Okay, what are the categories to consider regarding the standard deduction? Charity, property tax, Florida tax, perhaps medical, what else? So we can go down the line, each of them. So remember, you're going to be able to deduct the higher of your standard deduction or your itemized. So they made a few changes. Medical expenses, they're deductible to the extent that they exceed 7.5% of your total income. State income taxes and property taxes, that's been capped at 10. So if your property taxes are 10,000 and you live in a state with state income taxes, you're not going to be able to deduct anything above 10,000. So the cap is 10. Charitable deductions, that actually has a ceiling. You can deduct up to 60% of your total income. And then the thing that's really different this year is they've basically eliminated all miscellaneous itemized deductions. So that's why, back to our point, it's going to be a lot harder for you to get over that standard deduction hurdle going forward. And just a quick thing I don't think we made note of is, while they did increase the standard deduction, they eliminated the personal exemptions. So like me, for instance, I have 3 kids. So yeah, I had a lower standard deduction, but I also had the benefit of 5 personal exemptions because it's me, my husband, and 3 kids. So folks with big families are really going to notice a difference. Even though their standard deduction is higher, they may actually be paying more. So that it becomes even more important this year to run the numbers. And another question we have.
All right, so another question that came in, are all securities eligible for donation?
Very good question. We used to see this all the time. We had, again, it goes back to the do-it-yourselfer. So like HGTV has created this whole crew of DIY. But sometimes you think you're implementing the strategy correctly, and then you hit a wall. So you have to make sure that the securities that you're selecting to donate, you've held them for at least a year. They have to be long term. If you utilize by mistake short term securities, you're only going to be able to deduct the basis, the cost basis. So that really hurts. So you have to make sure that when you speak to your investment advisor, if you're trying to implement a donation of appreciated securities, I mean, hopefully they know, but they don't always know, is that you make sure you tell them it has to be long-term appreciated securities. Oh, here's another question, Yesenia. You can take this one. So you spoke about HSAs. What's the difference between an HSA and an FSA?
So that's a great question, and one that we actually get pretty often. So the HSA is different mostly in the fact that it's not a use it or lose it. The FSA, if you put funds in there and don't use it by the end of the year, there may be a grace period
I think March 15th, but
for about 500 of the funds. So if you don't use those funds in the FSA, they actually go to your employer, which is not the ideal situation. However, FSAs, if you don't have an HSA available to you, an FSA can be a really good way to get some funds in for medical expenses or dental. If you have kids coming up with braces, you know that's happening for a fact. That could be a really good way to get some dollars in there pre-tax. Or if you have kids, you can have dependent care funds go in there pre-tax as well. But again, you want to be careful with that. You want to be able to calculate how much you're going to need for the full year and only put in that much. Don't put in too much. Even though you'll get the deduction, you'll lose those funds essentially, so it won't be worth it.
Right, and one of the things I think we talked about even yesterday, because we were talking about our own company health insurance plan, with HSAs, if you're, let's say you just got pregnant, and you're not sure what your expenses, medical expenses are going to be, and you have an HSA eligible plan, it's so important to just open the account, even if you just fund it with $1, just to get the account open, because it can only be used to reimburse expenses that you incurred after the date that you established the HSA. So that's a key thing. So, I say you get pregnant, then right after you get that positive test, you should be opening up an HSA, and just to get the fund established so that you can use it to get those medical expenses as a deduction above the line via the HSA funding.
Absolutely. And we have another question here. What is the relationship between donating from an IRA versus a donor-advised fund regarding taxes? Which is more advantageous? So that's a fantastic question. In general, we like to recommend using the IRA just because it's an automatic deduction regardless of whether you're going to itemize or not. The donor-advised fund is a good way to help you itemize, but if you're eligible to take RMDs, we do recommend you do it from the IRA as opposed to the donor-advised fund. Also because it lowers your AGI, so you may be in a position where if you had extreme medical expenses and you weren't itemizing before, it could do
it could be a double benefit. So you're reducing your adjusted gross income, you're paying less tax, but it's also freeing up some of your medical expenses. But the thing with a qualified charitable distribution is you have to be over 70 and a half. You have to be required to take a minimum distribution. But the donor advised fund, just you think about that as a parking spot, essentially, and you're just trying to front load you're trying to front load all of your donations and put it in a little parking spot, just for purposes of being able to itemize.
And they're not mutually exclusive. If there's something that you want to do, maybe you want to donate from your IRA, but you also want to just get super crazy and get itemized deductions this year as well, you can do that as well, and then have a few years to choose which one of those charities are going to receive those funds. So they're not mutually exclusive. You can do both in different amounts. We could probably play with the numbers, run them, and see what they look like.
And that's a
Mhm.
good point because sometimes if we run the projections and we do this proactive tax planning and we say, oh, well, look at this, Yesenia, if you donate $10,000, it saves you $3,500 in taxes. Yesenia will say to me, but I don't want to give $10,000 to this organization all in one year. Maybe we can take the portion that you want to give this year, fulfill that with a qualified charitable distribution, and then the difference we can park it in a donor advised fund because then you can choose the timing of when you're going to make those donations in the future.
Exactly. So we don't want the tax tail to wag the dog. We want to be conscientious of the limitation of each of these strategies and see which one works best for you individually.
Exactly. Well, that pretty much concludes the questions. If you have any other questions and you'd like to have schedule a one-on-one call, maybe see how these strategies apply to you, perhaps maybe run the numbers, feel free to call us, any one of your advisors here at Tobias. But we want to thank you so much for tuning in, and hopefully we've put a fun twist to year-end tax planning because we surely enjoy it here.
Yes,
So
we do.
have a great afternoon and thank you for spending this hour with us.
Thank you. Have a good one.
Take care. Bye bye.